You may have noticed earlier in the month that we had a bit of market turbulence in global share markets in particular, with a lot of major stock markets down quite sharply over a few days. This was centered around Japan, and over a course of 3 days, the Japanese share market had one of the largest corrections it's had, one of the largest drawdowns it's had in over 50 years. And this did reverberate around the world. The likes of the US and European indices were down, not quite as much. They were down more like 8 or 9%. And closer to home, the more defensive New Zealand stock market down 3 or 4% over that time. Since then, there was almost just as quickly as markets fell, they then recovered, recovering over half of the losses in most cases. But what that does mean is that there is elevated levels of sort of volatility or turbulence in markets, and there are some measures for this. One of the most closely followed one in the US is the VIX index. It is known as the fear gauge because it does spike higher when markets are fearful, when investors are selling. That fear index is typically sort of in the teens. It has been a lot of the last year in the mid-teens, and over those few days in August, it spiked to above 60. That's sort of levels that we haven't seen since the early 2020, when the COVID pandemic was sort of taking place around the world. And as always with these corrections, there's usually never one specific reason for why it happened. The three main reasons would be the Bank of Japan. Now, famously, that central bank has kept interest rates very low for a number of years, even before the GFC and since, and they have finally started increasing interest rates there. And that has led to some concern that they're going to hike interest rates too aggressively. At the same time in the US, where interest rates have been well above average for a couple of years now, there are concerns that sort of very important economy for the rest of the world is showing some cracks. There was some weak employment data, some manufacturing activity lower, so the concerns there that finally those high levels of interest rates are going to have an impact and cause a slowdown there. And also with the Japanese interest rates being so low, the famous carry trade, where investors can borrow very cheaply in yen and invest in other asset classes. Now, that does involve some leverage. It involves borrowing in one currency to invest in another, and as always with unwinding of leverage, that sometimes the getting out of those positions all at once can cause these dramatic pullbacks in share markets. Going forward, it really does come back to fundamentals. The correction that we saw was well overdone compared to the fundamentals we're seeing. I talked about the US economy being a little bit weaker, but that was just some signs. There's still, on the flip side, there has been some more positive other bits of data. The corporate earnings season is almost concluded there, and it's been a lot of good companies doing very well. There are some companies having difficult times, but in aggregate, it was a sort of on par earnings season. So there is enough positive stuff there on the fundamentals, and it is those fundamentals that are the long-term drivers of these share markets. The correction we've seen, if we put that in context, it's getting on 2 years since the share market sort of had a decent trough as interest rates got hiked around the world. So, this is about the fifth or sixth sort of correction of this magnitude in those last 2 years. So this is sort of par for the course for investing in equities. And as always, what dictates where they go from here, it will be those fundamentals. And the key for that will be the extent to which central banks around the world can keep cutting interest rates. Like we talked about, the US Federal Reserve is expected to start very soon. Some central banks in Europe and the rest of the world have already began cutting interest rates, and that does cause businesses, consumers, governments to be able to spend a bit more on something else. And so that's going to be a positive for that fundamental backdrop.